In this video tutorial, we're going to look at the area of budgetary control. For the purpose of this video tutorial, we're going to look at the question, the Canal Bank restaurant. This question, and a range of other questions, and the associated video solutions can be found on my website, danielkingaccounting.wordpress.com. And you have the address here. Now, moving straight on to the question, the Canal Bank restaurant, that's what we're going to work on. So what we'll do is we'll start at the top here and we'll work our way down through it, highlighting the key areas. Starting at the top here, the management team at the Canal Bank restaurant draw budgets on a quarterly basis, so for 3 months. The following budgeted information, so this is the budget, information for the first quarter of the current financial year has been provided. And this is the budget information. Number of customers, or in the restaurant probably called covers, 50,000. The average spend per customer, €10. The food and beverage cost per customer, so that's per customer, so that will be a variable cost, €4. The direct labour cost per customer, also a variable cost, €1. The fixed labour cost, 98,000 for the quarter. And the fixed overhead cost, 62,000 for the quarter. So here we have the budget, or the plan for the next 3 months. Now, moving on down, we find we get the actual results. So the actual results for the first quarter of the current financial year were as follows. So we have the number of customers, 60,000. Total sales came to €540,000. The total food and beverage cost, 243,000. The total direct labour cost, 57,000. Fixed labour cost was €105,000, and the fixed overhead cost was €58,000. Now, what we're asked to do? Well, from the above information, you are required to A. Prepare a statement showing the fixed budget, the flexible budget, the actual results, and the variances for the quarter. So we're going to draw up a budgetary control statement. And in that budgetary control statement, we're going to have a column where we will construct the fixed budget, then the flexible budget, the actual results, and the variances. So that's the first thing we'll do. We'll draw up the statement. And then the second thing we'll do, part B, we'll prepare a statement reconciling the original budgeted profit with the actual profit. Now, drawing up this statement, a budget control statement, well, they have a very specific format to them. So what we're going to do is we're just going to have a look at the statement, a blank statement, and then we can start filling in the information we need. So if I draw one up here, we can see this is what our budget control statement would look like. Now do remember, you can pause, rewind, and replay this video at any time you like. But what we have here on the left hand side is our financial information. Sales, variable costs, contribution, sales, variable costs, contribution, fixed costs, and profit. So you note the financial information is set up as a marginal costing format. Now we have columns here for the fixed budget, the flexible budget, the actual results, and then over here on the right hand side I'm going to calculate my variances. Now in sales volume, first thing I'm going to do is I'm going to put in units, and I'll just write in units here. So across here I'm going to put in the total number of units. So the original budget is going to be drawn up based on 50,000 customers. So just go back and look at, we see number of customers, 50,000. And then if I go down this way, I'll put in the money. Well, it's quite useful to have your unit revenue and unit costs when you're drawing up the budget. So if I go back and have a look, I can see that's what I'm looking for there. Average spend, €10. The food and beverage cost per customer, €4. And the direct labour cost per customer, €1. So 10, 4, and 1. I'll pop that in there. 10, 4, and 1. Okay, now I'll start reconstructing my original fixed budget. So the plan was that we will serve 50,000 customers. Each customer will spend on average €10. So therefore, we would have been expecting €500,000 worth of revenue. In terms of the variable cost, each customer will cost €4 in materials. So the materials, the direct materials, that's the food and beverage. So therefore 50,000 by 4 will be 200,000. So we would expect to spend 200,000 in food and beverage, and the direct labour cost would be equivalent to €1 per customer. So that would be 50,000. That gives it a total of the variable costs of 250,000. Now, I'm going to have my sales revenue here. I'm going to take away from my sales revenue my total variable cost to get my contribution. Remember, it's always sales less variable cost gives contribution. So my contribution figure here will be 250,000. Now what I need to do, I need to pop in my fixed costs. So what I'll do is I'll just go back and have a look at them. So here they are here, the original budget figures, 98,000 and 62,000. So I'll pop those in here. So we'd have 98,000 and 62,000. Now if I add those two together, they come to 160,000. So what I have here is I have my contribution less fixed costs. Less fixed costs will give me my profit, and the profit figure 90,000. So 90,000 is the original budgeted profit. So what I do is I reconstruct my original fixed budget first. Now I'm just going to tidy this up, and then what I'll do is I'm going to move on and I'm going to pop in the actual information because I have that. Probably the easiest thing to do. So if I tidy this up here, so now we have it a little bit tidier there, and what we're going to do now is we're going to pop in the actual results. Not too much to do here in terms of calculations because we have the information. So we'll just go back to the question. So what I'm looking for now is the fact that there were 60,000 people. So I'm going to pop that in. So actually 60,000 people. And then I'll put money in here. So 540,000 is the total sales revenue, and then the total food and beverage cost, which is my direct materials, 243, and direct labor, 57. What I'll do is I'll pop that information in here. So I have 540,000 as my total sales revenue. I have 243,000 as my total variable material cost, the direct material cost, which of course is the food and beverage, and the direct labor cost, 57,000. Now if I add those two together, they come to 300,000. So what I have here, this figure 300,000 here, that is my total variable cost. I'm going to take it away from my sales, and I get my contribution figure, which works out at 240,000. Now what I need to put in is my fixed costs, which I will be putting in here. So I need to go back and have a look at those. And my fixed costs, actual results now I'm looking for, remember everything to do with actual is down here, 105,000 and 58,000. So I'll pop those in there. 105,000, 58,000, and if I add those two together, they come to 163,000. Now I have my contribution here, minus my fixed costs, gives me my profit, and the profit is 77,000. Okay. Now, I'm just going to tidy this up, and then we'll have a go at putting in the third bit, which is the flexible budget. So if I tidy that up, we now have the original fixed budget here. We have the actual results in here, and what I want to put in here is my flexible budget. Now, the idea behind the flexible budget is that we're going to adjust the original budget to take into account what actually happened. So what I'm going to do, I'm going to take this here, the actual number of customers that actually happened, and I'm going to write that in here. Now, what we're going to say to ourselves is, given the fact there were 60,000 customers, what should the revenue and the cost have been, and what should the profit have been? Well, all things being equal, 60,000 customers should have spent €10 each, which would given us a turnover of 600,000. 60,000 customers should have cost €4 each to feed, which would have given us 240,000. And 60,000 customers should have cost €1 each in terms of direct labour, which would have given us 60,000. Now if I add those two together, I get 300,000 Now 300,000 is the total of the variable costs. I'm going to take it away from the sales revenue, and I get a contribution of 300,000. Now, moving down here, all things being equal, we would expect the fixed costs to remain exactly as they were. The definition of a fixed cost is a cost that is unaffected by changing the level of activity. So given the fact that we're a little bit busier, we would have expected the fixed labour cost to remain at 98,000, and that the overheads should have remained at 62,000, which means the total for fixed costs should have remained at 160,000. So therefore, all things being equal, given the fact that we were busier, we should have made a profit of, well, contribution 300,000 less the 160,000 fixed costs gives us 140,000. Okay, so now we can see what happens. We can see the profit was budgeted to be 90,000. It should have gone up to 140,000 given the fact that we had 60,000 customers, but in fact it fell to 77,000. So we need to now find out what happened. Okay, but before we do that, we'll just tidy up this column here, the flexible budget column. So that gives us now those three neat columns: the fixed budget, which we put in first, the actual, which we put in second, and the flexed budget, which we just put in third. And now we're going to put in or calculate, should I say, the variances. Now, there are two distinct types of variances here. There are variances that are caused by changes in the price or cost, but the volume remains constant, so we will be comparing the flexible budget with the actual results. But there are also some variances that were caused by the fact that the volume changed. So it's gone from 50,000 up to 60,000. So in that case, we'll be comparing the original fixed budget with the flexible budget. So starting off, I'm going to compare these two figures here. So we have the flexible budget sales of 600,000 with the actual sales of 540,000. Now the variance, which is basically a difference, the difference between those two is 60,000. So we have to label that. We have to label it now either with the letter A if it's adverse or detrimental to profits, or F with favourable or beneficial to profits. So all things being equal, sales revenue should have been 600,000. It in fact was only 540,000, so that's not good. Profits will be down, so that is an adverse variance. Then I move on to my direct materials, and I'll compare these two. The difference there is 3,000. Now what we have here is the fact that the material cost, i.e. the food and beverage cost, should have been 240,000, given the fact that there were 60,000 meals served. It in fact was 243,000, so costs have gone higher than we expected, so that is adverse. The direct labour, well, should have been 60. It was actually only 57. That's a difference of 3, but the cost has gone down. So that means we'd be better off. So that is favourable. Moving down here now, the fixed labour cost. Now fixed labour costs aren't supposed to change, but in this case they did. They've gone from what they should have been 98 up to 105. That's a change of 7. The costs have gone up, so that is bad for us. Bring down the profits. That's an adverse variance. And the fixed overheads, well, they've actually gone down. So there's a 4,000 favourable variance. Now what we have here is we have sales price variance, material cost variance, direct labour cost variance, fixed labour cost variance, and the fixed overhead cost variance. They're all price or cost variances. We also need to look at the impact of the volume change. And to do that, we will compare these two here. The contribution from the original budget with the flex budget. So if you notice here, this column here, this 250,000, is drawn up based on 50,000 people using the original budgeted sales price and revenues. This figure here, 300,000, is drawn up based on 60,000 people, but using the same original price and cost information. The difference is 50,000, and the extra 10,000 people should have driven the profit up by 50,000. So therefore, that is a favourable variance. So the increase in volume drives up the profit, but unfortunately other things drove the profit down. Okay, so I'll just tidy this up a little bit. So if I just drop in the numbers there, and that's what we have. So that is our budgetary control statement completed. Do remember with these, we're comparing these two here, which is the sales price variance, these two here, material cost variance, these two here, labor cost variance, these here, fixed labor cost variance, here, fixed overhead cost variance, these here, which is a sales volume or sales contribution volume variance. Now, if we just go back to the question and have a look and see what we're asked to do, we can see here we're asked to prepare a statement showing the fixed budget, flexible budget, accurate results, and the variances. We have done that. That is now complete. So what we need to do now is to prepare a statement reconciling the original budgeted profit, which we know was the 90,000, with the actual result, which we know was 77,000. So we just have to go back to our table here. So I want to compare, or I want to reconcile this figure here with this figure here. And I'm going to do that using the variances. So it's simply a list. The other thing I'm going to do is I'm going to group the variances. So what I'll do is I'll group this figure here, which is a sales price variance, with this one here, which is a sales volume variance. I'll group these two together, because these are variable cost variances. And I'll group these two together. These are fixed cost variances. It's very simply a list. And if you have a look now, just drop in here the reconciliation. We start off at the top of the page with the original budgeted profit. There it is there. And then I'll step into this column here and I'll simply list my variances. Sales price, sales volume, materials and labour, they're the variable ones, and then the fixed labour and the fixed overheads. So if I just drop in those figures, I have, I'll just remove this here, that's it. So what I have here, the sales price variance was 60,000 adverse. Now adverse variance is dragging down profits, so therefore I'm going to treat that like a minus figure when I'm adding them up. We have a 50,000 favourable volume variance, so that would boost profits, so I'll treat it like a plus figure. Materials is 3,000 adverse, dragging profits down. Labour 3,000 favourable, bring profits back up again. We have the labour cost variance, 7,000 adverse, that will bring the profits down, and 4,000 favourable for the fixed overhead cost variance. So I'm going to add this up. So I'll have a minus 60 plus 50 minus 3 plus 3 minus 7 plus 4, and if I bring the total out here, I will get a minus 13,000, which means I have a net adverse variance. So then the original budgeted profit, 90,000, minus the net adverse variance of 13,000 gives me the actual profit of 77,000. Okay, if I just go back here, we can see that's what the actual profit was. So I've reconciled the original budgeted profit with the actual profit using the variances. Now I'll just tidy that up. There it is there. And that's it. So we've completed part A, which is drawing up the budgetary control statement. There. And then we've completed part B, doing the reconciliation. There. Okay. Thank you very much.